JSW Cement Limited is one of India's fastest-growing cement manufacturers and a pioneer in sustainable construction solutions. Recognized among the top 3 fastest-growing players in the industry, company is also ranked among the top 10 cement companies in India based on installed production capacity and sales volume. The company stands out for its leadership in green cement, particularly as India's largest producer of ground granulated blast furnace slag, GGBS, an environmentally friendly product made from a byproduct of steel manufacturing. In FY 2025, JSW Cement commanded an impressive 84% market share in GGBS sales, reaffirming its dominant position in the green cement segment. A key strength of JSW Cement lies in its strategic synergy with the JSW Group, especially JSW Steel. This integration allows the company direct access to captive raw materials, giving it a significant competitive edge. Not only does this vertical integration help reduce production costs, but it also insulates the company from raw material price fluctuations, enhancing overall operational stability. Looking ahead, JSW Cement is pursuing an ambitious expansion strategy. The company is significantly increasing its production capacity through the development of new manufacturing plants and modernization of existing ones, with a particular focus on northern India. This bold growth initiative is aimed at capturing new market share and reinforcing its presence across the country. With sustainability at its core and a clear vision for the future, JSW Cement Limited is playing a crucial role in building a greener, stronger India. JSW Cement Limited is launching its initial public offering with a total issue size of Rupee 3,600 crore. The price band for the issue has been set between 139 and 147 rupees per share. The IPO will open for subscription on August 7 and close on August 11. The tentative date for share allotment is August 12, and the company is expected to be listed on the stock exchanges by August 14. Now let's take a detailed look at the conservative discounted cash flow model in the conservative case for JSW Cement Limited. I have projected the company's financials under the assumption that revenues will grow steadily at 15% per annum, while the EBITDA margin will gradually decline from 14% to 12% over the forecast period. This model reflects a cautious outlook on profitability, factoring in potential cost pressures and margin compression in a competitive cement industry landscape. Revenues are projected to rise from 6,802 crore in year 1 to 25,124 crore by the terminal year, showing strong top-line momentum. However, due to rising costs and a conservative margin assumption, the growth in operating profits is more muted. Cost of goods sold (COGS) also scales up alongside revenue, moving from 5,863 crore in year 1 to 22,109 crore in the terminal year. Depreciation increases steadily from 341 crore in year 1 to 1,007 crore in the terminal year, reflecting the company's ongoing investments in capacity expansion and plant modernization. Consequently, EBIT earnings before interest and taxes moves from 598 crore in year 1 to 2,008 crore in the final year. The net operating profit after tax, EBIT after tax, increases from 451 crore to 1,516 crore over the same period. To calculate cash flows, depreciation is added back to EBIT after tax, resulting in an increasing operating cash flow across the forecast horizon. Capital spending remains substantial throughout the projection, starting at 921 crore in year 1 and peaking at 1,891 crore in year 10, before moderating to 1,107 crore in the terminal year. Working capital changes also affect free cash flow, fluctuating across the years with both positive and negative adjustments. For example, year 2 shows a release of 153 crore, while year 6 sees an increase in working capital requirement of 268 crore. As a result, free cash flow to firm (FCFF) begins negative in the initial years, with year 1 recording a negative 262 crore, reflecting heavy capital investment and moderate cash inflow. Year 3 remains nearly flat at negative 0. Year 4 onwards, as revenues scale and operating leverage improves, free cash flows turn positive and rise steadily, from 285 crore in year 4 to 693 crore in year 6 and 861 crore in year 10. The terminal year free cash flow is projected at 1,535 crore, marking the company's improved cash-generating capacity. When these cash flows are discounted using an 11.4% discount rate, the present value of each year's cash flows provides insight into intrinsic value creation over time. The present value is negative 235 crore in year 1 and marginal in year 3 at negative 0. Over time, the value contribution strengthens, with the highest present value observed in year 6 at 363 crore. The terminal year adds a substantial 308 crore to present value, highlighting the importance of long-term cash flow in overall valuation. Based on the discounted cash flow analysis under the conservative case, the present value of free cash flows to the firm, FCFF, during the high growth phase is estimated at 1,405 crore. The present value of the terminal value is significantly higher, at 13,379 crore, reflecting the long-term earnings potential of the business. Together, these values bring the total enterprise value of JSW Cement Limited to 14,784 crore. After adjusting for the market value of debt, which stands at 6,166 crore, we arrive at a market value of equity of 8,618 crore. Including cash and cash equivalents of 865 crore, the total value of equity in common stock comes to 9,483 crore. With 136.3 crore outstanding shares, this results in a per-share valuation of around 70 rupees. This valuation is built on cautious assumptions, including a 15% annual revenue growth rate and a gradual decline in EBITDA margin from 14% to 12%. Now let's look at the base case. In the base case DCF scenario for JSW Cement Limited, revenues are projected to grow robustly at 18% annually, reflecting the company's aggressive expansion strategy and strong demand outlook. Starting from 6,979 crore in year 1, revenues steadily rise to 30,956 crore in year 10 and reach 32,504 crore in the terminal year. However, the EBITDA margin is conservatively expected to decline to 13%, anticipating increased competition and input cost pressures over time. This results in EBIT moving from 622 crore in year 1 to 1,009 crore by year 10, and further to 1,060 crore in the terminal year. Cost of goods sold (COGS) scales proportionally with revenue, increasing from 6,016 crore in year 1 to 26,189 crore in year 10, and 27,628 crore by the terminal year. Depreciation reflects rising capital investment, starting at 341 crore and growing to 1,009 crore in year 10 and 1,060 crore in the terminal year. Net operating profit after tax, EBIT after tax, increases from 470 crore in year 1 to 2,837 crore by year 10 and 2,881 crore in the terminal year. When depreciation is added back to EBIT after tax, cash flow from operations improves each year. Capital spending remains high throughout the forecast, peaking at 1,990 crore in year 10 before moderating to 1,166 crore in the terminal year. Changes in working capital fluctuate, with negative adjustments in several years due to business growth, such as a working capital requirement increase of 472 crore in year 10, while some years see releases, like 310 crore in year 5 and 339 crore in year 8. As a result, free cash flow to firm, FCFF, begins negative at 270 crore in year 1, but turns positive from year 2 onward, growing from 120 crore to 590 crore in year 5, and peaking at 2,328 crore in year 10. The terminal year free cash flow is projected at 2,930 crore, reflecting the company's long-term earnings power. When discounted at a rate of 11.4%, the present value of FCFF turns positive in year 2 at 96 crore and increases to 448 crore in year 4 and 757 crore in year 6. Year 10 contributes 836 crore, and the terminal year adds 929 crore in present value. These discounted values indicate a steadily improving cash flow profile and validate the strong fundamentals and earnings potential of JSW Cement under this base case. Under the base case DCF scenario, the present value of free cash flows to the firm, FCFF, during the high growth phase is estimated at 4,372 crore, while the present value of the terminal value contributes a substantial 25,531 crore. Together, these components yield a total firm value of 29,904 crore. After adjusting for the market value of debt at 6,166 crore, the equity value of the firm stands at 23,738 crore. When cash and cash equivalents of 865 crore are added, the total equity value in common stock increases to 24,603 crore. With 136.3 crore shares outstanding, this results in an estimated value per share of 180 rupees. Now let's see the optimistic case. In the optimistic case for JSW Cement Limited, I assumed a strong annual revenue growth of 22%, supported by expanding market presence, rising demand, and operational leverage. Revenues are projected to rise sharply from 7,216 crore in year 1 to 43,204 crore in year 10, eventually reaching 45,364 crore in the terminal year. This aggressive top-line growth is paired with improving profitability, as EBITDA margins are forecasted to rise from 14% to 17%, driven by operating efficiency, capacity utilization, and favorable pricing. As a result, EBIT increases significantly from 655 crore in year 1 to 6,266 crore by year 10, and further to 6,579 crore in the terminal year. Net operating profit after tax, EBIT after tax, jumps from 494 crore in year 1 to 4,731 crore in year 10 and 4,967 crore in the terminal year. Depreciation rises proportionately with asset base expansion, growing from 341 crore in year 1 to 1,079 crore in year 10 and 1,133 crore in the terminal year, adding back to operating profits to reflect true cash flow. Capital expenditures remain substantial, reflecting JSW Cement's continued investments in expansion and modernization, ranging from 921 crore in year 1 to 2,128 crore in year 10, and tapering slightly to 1,246 crore in the terminal year. Changes in working capital fluctuate, with higher requirements in growth years, such as an outflow of 779 crore in year 10, and inflows in some years like 523 crore in year 8. Despite high investments, free cash flow to firm, FCFF, turns decisively positive from year 2 onward. After a negative 281 crore in year 1, FCFF surges to 383 crore in year 3, 2,078 crore in year 6, and peaks at 4,461 crore in year 10. The terminal year free cash flow is projected at a robust 5,069 crore, showcasing the firm's growing cash-generating ability under an optimistic scenario. Discounting these future cash flows at 11.4%, we see substantial value created over time. The present value of FCFF moves from negative 252 crore in year 1 to 443 crore in year 5, and reaches a high of 1,601 crore in year 10. The terminal year adds a present value of 1,433 crore, highlighting the long-term strength and sustainability of JSW Cement's financial performance in a high-growth, high-margin environment. Under the optimistic DCF scenario, the present value of free cash flows to the firm, FCFF, during the high-growth phase is estimated at 7,289 crore, while the present value of the terminal value contributes a significant 44,183 crore. Together, these figures yield a total firm valuation of 51,472 crore. After accounting for the market value of debt at 6,166 crore, the equity value of the firm stands at 45,306 crore. Adding cash and cash equivalents, which includes IPO proceeds, is 865 crore. The total value of equity in common stock comes to 46,171 crore. With 136.3 crore outstanding shares, this results in a per-share intrinsic value of 338 rupees. I have calculated all the 3 scenarios. It is important to emphasize that this analysis is for educational purposes only and should not be considered as a recommendation to buy any security. I am not a Securities and Exchange Board of India registered investment advisor. Please consult your financial advisor before making any investment decisions, reflecting strong growth expectations and enhanced profitability under this best-case outlook.